Hello, Anthony.
Hello, Claudine.
Today we're talking about avoiding Form 926 penalties.
Oh, yeah.
Yeah. Form 926 is used when a transfer of property is made to a foreign corporation. We'll get into some details on that later. What about Form 8865?
Right. Well, if you're making a transfer to a foreign partnership, you say, oh, I need to file a Form 926. Actually, you use the 8865. There's a schedule on there. You put it. And you would think that there would be a Form 5471 equivalent where you could just put that on there. But no, there's a whole separate form, Form 926. And we've probably lost 90% of our viewers right there. But hang in there.
Yes.
There's more.
Trust me, it's important. Now, part of the reason we want to talk about this is we've been talking a lot lately about IPUs, International Practice Units. And you said basically it changed the way the IRS is doing audits.
Yeah. Exactly. You know, the old way was, here's the taxpayer, find the issues. Okay, now what has changed is, here's the issues, find the taxpayer.
A lot easier,
Yeah.
a lot more specific.
Yeah.
An easy way for the IRS to get a lot of revenue because they are pretty short-staffed. We
That's
know
right.
that.
Yep.
It looks like they're targeting, well, it doesn't look like, they've said they're targeting LB&Is.
Yeah. Large business and international, right?
Multinational corporations. There's actually a couple IPUs that affect expats.
That's right. Oh, more than one. Yeah.
Yep. So an IPU is, they're saying, an explanation of general international tax concepts, but they're not official laws.
Right. But the IRS treats them as laws, so you have an uphill battle there.
They can interpret them as they see fit.
That's right.
Yeah.
Yeah, and the IPU is really their issue that they're seeking to audit. And in IRS speak, it doesn't really make sense. International Practice Unit, okay, I guess that's where people work or something. No. These are the things they're targeting. They're looking for these issues, and hopefully they just find the taxpayer to hit it with. Yeah.
And one way they're trying to really streamline it is, now that I've gotten into the meat and potatoes of the IPU for Form 926, they are really specific instructions for these auditors.
Yes.
On how to audit in the most efficient way possible.
You know, and that brings up something interesting, is how specific the IRS has to be. And it makes sense. It really makes sense. If I was managing it, I would probably do things probably this way. Why? Because it's so complicated. When you're trying to train a staff to do something, you can't just go into, they can't see the whole world, because if they see the whole world, they'll never get anything done. You have to get them very, very specific and focused.
Yes, this IPU is 58 pages long, just one. And they think there's 124 IPUs so far.
And I believe the IRS is these IPUs, that there's just a Form 926 IPU. That's where I work. So all day, every day, this Form 926 with many people with foreign corporations don't even know exist, but they had to make it so specific because it's sort of this tacit admission that, foreign reporting is so complicated, we have to do it this way. Yeah.
And now you had said it's easy for the IRS to sort of find who should have filed a Form 926 because, for instance, if they filed a Form 5471, they may have to do a 926. So they can just look at all these.
And I think that's what makes it so easy, because in the beginning we said how the foreign partnership form, there is no Form 926 for when you transfer property, intangible or tangible, to a foreign partnership. Rather, it's Schedule M, I believe, on 8865. Now, this is the thing. When you're looking now on Form 5471, the Schedule M is totally different. It's not that at all. When you're looking at Form 5471, if someone has filed all their Form 5471s correctly, you could tell when a 926 should have been done.
And the IRS looks at it as if, well, you knew you had to file a Form 5471, so obviously you're good with this bookkeeping. You should have known it's willful neglect, which we'll talk about in a second.
Right.
So Form 926 is the IRS filing requirement for U.S. transfers of property to a foreign corporation. The transfers include, but aren't limited to, a transfer by a U.S. person of property to a foreign corporation in exchange for the corporation's stock, where the U.S. person alone or together with others making contemporaneous transfers controls the corporation immediately after the exchange. Also, an exchange by a U.S. person of stock or securities of a domestic corporation for stock of a foreign corporation pursuant to a plan of reorganization. Transfer by a domestic corporation of its assets to a foreign corporation in a reorganization, and it can be tangible or intangible. This special rule I thought was very interesting, and I think this is where a lot of people are going to get into trouble. Special rule, the IRS says transfers by a partnership. If the transfer is a partnership, domestic or foreign, the domestic partners of the partnership, not the partnership itself, are required to comply with IRC 6038B and file Form 926. Each domestic partner is treated as a transfer of its proportionate share of property. So it's not one Form 926 for the corporation. It's every partner has to file, I assume, the same one with their share of the business.
Right. It's now this is something because what happens when you have something called an LLP, a limited liability partnership? It's not a partnership. It's not. It's something that's created by state law. Partnerships are sort of the default agreement. If two people have an agreement, that's a partnership. But when you have a limited liability partnership, what's that?
Yeah, and you could just go, you know what? Joe filed it. I'm fine.
Right. Or if you have a limited partnership? There's one managing partner, and the other ones are just limited partners. Their liabilities are limited. They're not even thinking. that they have to do anything. I just basically, what's your job as a limited partner? I just sit quiet and collect my check. Yeah, that's really your job. So, does a general partner have to do it, or do all limited partners have to do it?
And now the penalties for failure to file is in typical IRS fashion are not fantastic.
No.
10% of the fair market value of the transferred property, up to $100,000. The period of limitations on assessment of tax for the taxable year, which includes the date of the transfer, remains open, and that is forever?
That is forever.
Jeez.
Yeah.
This is where it gets interesting. This penalty should not be asserted if the U.S. person shows that the failure to comply was due to reasonable cause and not willful neglect. The penalty is not limited to $100,000 if the failure to furnish the information was due to intentional disregard. So 3 phrases there that I don't like.
Yeah.
Reasonable cause, willful neglect, intentional disregard.
Right, and they're all sort of weird. The way they write all this law is like, here's the penalty unless you have reasonable cause. So you are the one who has to prove reasonable cause. The IRS doesn't have to prove willful neglect. That's really how it works, which is sort of nasty because it was a great way to lower the bar of what they need to prove. Now, this willful neglect standard, we've actually seen a lot of FBAR examiners apply this one because they've been trained on some of these international penalties. They see the FBAR, they're treating it like a Title 26 penalty. And by the way, because all these penalties come from Title 26 of the U.S. Tax Code at 6038B. That's where they come from. Your 6038B, we'll say it a little bit quicker there. So that's where they come from, but your FBARs come from Title 31. So that is not a Title 31 standard. We've seen them do it. Now, willful neglect, okay, I'll tell you how it works in the real world. That's negligence to an examiner. Oh, you made a mistake. You should have known. The end of it. But but willful neglect actually requires a state of mind to be willful. You can't accidentally be willful. You can't. That doesn't work like that. You have to, otherwise you're intending to be negligent. What the hell does that mean? It's like, well, do you mean recklessness? Because that's what you really mean is recklessness, is the standard that, hey, look, what you were doing was so risky, it was a virtual assurance something bad would have happened. That would be nice if they actually put a more of a legally recognized standard state of mind in here instead of coming up with these things that are so vague. And, by the way, these examiners, as fine as they are, they're not attorneys. I'm sure there are some attorneys there, but for the most part, they're not. So they don't know what happens in court. They don't know what evidentiary state of proof is required. So they're just sort of kind of coming up with things. And it's really dangerous to have an examiner be the one to assess what someone's state of mind is when they're not really familiar with what is negligence. Have you studied? Did you take a class in torts? Did you take a class in criminal law? Did you take a class in evidence? Did you do this at any point? Yeah,
this is going to again affect taxpayers who literally didn't know they had to file this more than I'm picturing like a businessman with a shirt unbuckled, maybe a couple drinks and a cigarette and messy hair saying, screw you, IRS, I'm not going to pay you. Not even pay you, file this form.
Right.
But that's maybe 1%.
Right, or just like, yeah, there's probably a whole bunch of stuff I'm going to do, but I'm just going to not do it. That's right.
I'll do my 5471, but not my 926.
I'm not going to look any further than the 5471. That's probably it. Right, that's what the standard Seems to be though. Like you were, the example we're taught in law school is you weren't just speeding, because that could kind of be negligence. You were going too fast, but everybody kind of goes too fast. So yeah, it's negligent. But speeding, going 100 miles an hour through a crowded town, well, you're virtually assured that somebody is going to be injured. So that gets to recklessness, maybe even can get to depraved heart murder if somebody's killed. When you're doing something so risky, the result is incredibly probable.
Yet in the IPU, it says that they can determine reasonable cause by looking at basically your reporting requirement. Are you good at reporting your stuff? And if you are, probably willful.
Yeah, probably didn't want, right. So they're using it against you?
Yep.
Yeah.
We will be talking more in upcoming videos about appeals, because we definitely want to appeal.
That's right. Yeah, and this
comes
is
up.
This is where we get into a lot of the what we need to do is take a look at the record. Hopefully we get the case from the beginning. Sometimes we could still help out if a case has gone bad, because the appeal, and as we'll talk about more, gets into a lot of the state of mind that we're talking about.
Yeah. So if you are unsure if you are supposed to file Form 926, you're concerned about the penalties, about an audit, don't hesitate to contact us. We are international tax experts. We can help you out. You can call us at 888-727-8796. You can email us info@irsmedic.com. Visit our website, irsmedic.com. You can like and comment below and subscribe to our channel so you can get updates when we have more awesome tax videos. Thanks for watching. IRSMedic, the law offices of Parent and Parent, LLP. Real tax attorneys for tough tax problems.